Hello, everyone, and warm greetings to all participants in this session. This is the second session of the FMM Conference that is replacing the annual Berlin Conference that every year promotes exchange between competing theoretical paradigms and covers current macroeconomic theories and issues. The online event this year is called the Corona Crisis Macroeconomic Implications and Policies for Sustainable Recovery. And the session's topic for discussion is Theories of Inflation. Do central banks control the price level? With a question mark. My name is Andrea Terzi, and I will be the moderator of this session. I will start by making a few introductory remarks about the context in which this discussion of inflation is taking place. I will then introduce our three speakers. We will then listen to their contributions in the order of the program, and I invite all registered attendees who would like to ask questions to our speakers to do two things. Write their question in the chat and indicating which speaker they are asking their question to, and number two, raise their hand. And if there are no technical issues, we'll give the floor to ask your question. Or you may also state that you prefer that I deliver your question to the appropriate speaker. The Q&A session will be at the end of all three presentations, and the session will end by 6:30. So two observations about our topic. The question of whether central banks control the price level is a question that has gained prominence in the wider debate of monetary policy after a number of central banks in the developed countries have consistently undershoot their own target of inflation for well over a decade. And this has been drawing attention to how weak is the proposition that central banks can control inflation. This was the pre-COVID-19 world. Now, on the one hand, in the midst of a looming pandemic that threatens human lives as well as social relations, the question may seem less urgent when the primary goal is to end the pandemic, save lives, and limit the costs borne by the most vulnerable members of society. On the other hand, concern about prices still here, such as will the COVID economy lead to inflation or more deflation? The consensus here is leaning towards the latter, but the answer depends on how you model inflation. And here views are diverse, ranging from the Phillips curve fashion, the real rate of interest fashion, the struggle over income shares approach, or model being logically founded on the notion that inflation is the outcome of the currency issuer. This being a monetarist view that has recently revamped with a quite different twist by modern money theory. So the question, do central banks control the price level, is a difficult one, and we look forward to our speaker's wisdom. And our panel includes Frances Coppola. She's a financial writer and commentator. She's the author of The Case for People's Quantitative Easing. And I'm sure she never believed that QE would be inflationary. Scott Fullwiler, University of Missouri, Kansas City, and he's also a scholar at the Global Institute for Sustainable Prosperity. And Karl, Whelan, University College Dublin, and a research fellow in the Center for Economic Policy Research. I would like to thank all speakers for accepting this invitation, and without further ado, I'd like to give the floor to Frances Coppola. The title of the talk is Inflation is Always and Everywhere a Political Phenomenon. Frances.
So inflation is always and everywhere a political phenomenon, and you'll note that in my image it is a deflated balloon, because right now, and indeed for the last decade, and in the case of Japan for approximately the last quarter century, the challenge for central banks has not been, for central banks in the advanced world certainly, has not been inflation so much as disinflation or even deflation. And their record on trying to quell deflationary forces has been, how we say, patchy. So I want to discuss some of the reasons why central banks might be struggling to raise inflation to target, and to unpick some of the beliefs that I think underpin the whole framework that we've created around central banks over the last quarter century, and why I think it's founded on some very mistaken beliefs that really have contributed to the reasons why central banks are finding it so very difficult to get anything moving at all. So I'm starting with Milton Friedman. This is possibly the most famous thing that has ever been said about inflation. Inflation is always and everywhere a monetary phenomenon. Friedman was, of course, writing about the Great Depression and talking very much about the way in which the collapse of the money supply in the Great Depression contributed to the Depression, deepened it and worsened it. And his argument was really amounted to that when banks are failing to create money, I'll talk a little bit about that in a minute, that the public authority really should step in and replenish the supplies. I don't think anybody would very much agree with that. Disagree with that. The problem is that when you generalize from that particular application of it, you then get into problems of political economy. And applying that aphorism to everything ignores the political economy of inflation. This is the conventional view, at least the conventional view as it has been for the last several decades. We have a separation of monetary and fiscal policy. Creation of money, broadly speaking, is monetary policy. The distribution of money, broadly speaking, is fiscal policy. Monetary policy is the responsibility of central banks. Distribution of money is the responsibility of fiscal authorities. And then these are the beliefs. Inflation will be uncontrollable if governments are responsible for money creation. So we need independent central banks. Inflation will be uncontrollable if governments control the distribution of money. Wait a minute, didn't I just say the distribution of money is the responsibility of fiscal authorities? Well, no, what we need is independent fiscal authorities. So either that or we must fence in governments with legislation that restricts what they can do. So we have fiscal rules. We have balanced budget requirements. We have debt breaks. Some people call for independent fiscal councils. We even have a quasi-fiscal central bank. All of these things aim to restrict the power of governments to influence the creation of money and control its distribution, to decide where it goes in the economy. And that's because the distribution of money is every bit as important for inflation as the supply of money. To keep inflation low and stable, therefore, the belief is, decisions about creation and distribution of money must be insulated from politics. The reality, and I think we've discovered this in the last 10 years, is that it's not as simple as that. Monetary policy has fiscal effects. So conventional interest rate policy, we don't think about this very much, but broadly speaking, those who are older and richer tend to have savings on which they earn interest, want to earn interest, and those who are younger and poorer borrow to smooth their consumption, to enable them to buy assets or whatever. And so if we conduct a monetary policy in a way that raises the cost of borrowing, we are improving the incomes of the older and richer who are receiving interest on their savings and hurting the incomes of the younger and poorer who need to borrow. On the opposite direction, if we depress interest rates, then we are depressing the incomes of people on fixed incomes, broadly speaking, the bottom end of the older and richer distribution, and making it easier for younger and poorer people to borrow. It's quite not terribly surprising that we tend to end up with a lot of debt and some very cross older people. So monetary policy has fiscal effects, and particularly so with QE, which raises inequality. This is not a controversial statement. It raises asset prices. Assets tend to be held by older and richer people, so it has intergenerational and class effects. It raises wealth inequality. It also has trickle-down effects. We don't know exactly what the scope of those trickle-down effects are, but I think we're fairly certain that the headline impact of QE is to increase wealth inequality. Fiscal policy also has monetary effects. Scott, no doubt, will talk through the way in which government spending increases the supply of money in the economy. I'm going to park that for a minute because I'm going to assume that all fiscal spending is fully sterilised by bond issuance. So I'm just going to talk about the distributional effects, right? So if I target my fiscal policy towards younger and poorer people, if I give people at the bottom end of the income distribution money, I may not have, and I do that by taking money off people who have saved that money, who are sitting on it, that I may not have actually increased the overall amount of money in the economy, but I may have made it move a darn sight faster, because I've moved it from people who don't want to spend it to people who do. So fiscal policy also has monetary effects. And both of those are influenced by politics. I'm sure you can hear the political aspects of everything I've been saying. Over the last 10 years, there have been campaigns by savers for higher interest rates. There have been campaigns by young people for more consideration of the downwards pressure on their incomes from fiscal policy. There are political influences on both monetary and fiscal policy, and both of them have political consequences. The propensity of monetary policy to raise inequality has consequences in the political realm. So does the effect of fiscal decisions that favour some groups in society above others. We can't say that there's any way in which monetary policy can be insulated from politics, and there isn't really any way in which fiscal policy can be either. The distinction between monetary and fiscal policy is largely artificial, and central banks and fiscal councils are political actors. I'm going to talk a little bit through how money is created, just briefly. Most money circulating in the economy is created by commercial banks in response to private sector demand for loans, and it's mostly these days to purchase assets. In Western economies, most bank lending, if you look at the balance sheets of banks, they're stuffed full of mortgages. Maybe not in America, where they sell on their mortgages into the capital markets, but it's still millions and millions of dollars worth of mortgage origination. It's not, as it used to be, maybe half a century ago, bank lending for small businesses. That's quite a small proportion of bank lending these days. There's much more lending against property, and even much small business lending is against property. So we are not talking about productive lending into the economy that gets the economy moving, supply side improvements and all the rest of it. We're really talking about bank lending to help people buy assets. And it is of the nature of our populations that older and richer people are less likely to need mortgages to buy property than younger and poorer people. If they're richer but they're young, they don't need mortgages. And if they're older, they've probably paid off their mortgages. So therefore, we have decided collectively, if you like, that the rate of money creation in our economy broadly depends on the propensity of younger and poorer people to borrow. And that has been actively promoted by government at times. I'm thinking, for example, of the Clinton administration's determination to push home ownership down to lower income levels, which had unfortunate consequences for some of those people. Central banks influence the appetite of these people to borrow by adjusting interest rates, but it is only an influence. If I talk about how fiscal decisions influence bank money creation, if we squeeze the incomes of younger and poorer people with tax and spending policy, they're less likely to borrow. If we increase the income, for example, by tax cuts, we don't make them any more likely to borrow because they probably don't borrow anyway. They might leverage themselves up to acquire a few more assets, but you're not going to see this broad-based borrowing that the economy has come to depend on for the creation of money. So fiscal consolidation targeted at younger and poorer people actually results in a lower rate of bank lending, and fiscal expansion targeted at old people, Trump tax cuts and what have you, richer people, Trump tax cuts, whatever, does not increase bank lending. Central banks can offset these effects with monetary policy. So QE, for example, done in the right way, can compensate for a failure of bank lending to increase the amount, the N1 money supply in the economy. The problem is that just increasing the money supply does not necessarily raise inflation, doesn't necessarily do anything much for the economy either. And for me, the bigger issue is this, that fiscal policies have an effect on aggregate demand. We've come to think that central banks control demand and the government's responsibility, fiscal authorities' responsibility is kind of distribution and the supply side, isn't it, and the longer term direction of the economy. Now, actually, fiscal policies have demand effects. So what I was saying just now about squeezing the incomes of younger and poorer people not only makes them less likely to borrow, but it also makes them less likely to spend. It may even force them to cut back their discretionary spending. Meanwhile, policies that increase the incomes of the rich do not make them more likely to spend. I mean, there is nothing controversial here. I'm simply saying that those with a higher marginal propensity to consume tend to be poorer. This is not controversial. So again, if you're doing fiscal consolidation and you target your tax rises and spending cuts at the lower end of your income distribution, you will have more of a disinflationary effect than if you target them at the upper end of your income distribution. And conventional central bank monetary policy cannot significantly offset this because of its own distributional consequences. So I want to move on a little bit and talk about some of the beliefs that underpin this mess, where we've ended up with a belief that central banks can somehow control inflation, even though all they really control is interest rates in markets and bank lending, and they have no control at all over the distribution of money to households and even to some extent to smaller businesses, and no ability to offset decisions made by fiscal authorities that redistribute wealth from younger and poorer to older and richer, or vice versa for that matter. And also some of the beliefs about, well, maybe it's not what we do now that matters, but what people believe about what will happen in the future. So I've started here with a discussion about inflation expectations. Now, if I talk a little bit about inflation expectations, because what's happened is that central banks are kind of looking to stabilise inflation at or around the target over the medium term. So what they want to do is convince everybody that they can do that. And so rather than looking at what is happening now with inflation, what they're monitoring really is what people believe inflation will be in the medium term. So if we look at the ECB, for example, the preferred measure of inflation, of future inflation expectations, five-year forward interest rate swap. In America, they seem to like looking at tips. Which is all about how people see the future path of inflation based upon what they're being told by the central bank. Now, this would be fine if central banks actually came close to meeting their interest rate targets. And during the Great Moderation in the period of sort of mid-1990s up to the financial crisis, they broadly did. But since then, most central banks have struggled to meet their target. The ECB has barely managed to do so at all in the last decade. The Fed has not done so consistently either. The Bank of England has been a bit of a sort of a up and down yo-yo, and it's mostly, in my view, been driven by fiscal policy. And the Bank of Japan, well, yeah, okay, that didn't even have a target for a long time. And when it introduced a 2% target, everybody laughed. So my question to those who say, well, it's all about expectations, it's all about making sure that expectations are anchored so that people believe the central bank's forecast that it will return inflation to the target within the next 5 years. Why it would be rational for people to believe that if it hasn't done so for a decade? And furthermore, why would those who favour raising the inflation target in order to bring inflation closer to target and get the economy moving again, why would raising the target change their expectations? If they don't believe it's going to meet a 2% target, why would raising the target to 4% make them any more likely to believe it? It seems to me there's a fair degree of irrationality about the theory of inflation expectations. And while we're on the subject of inflation expectations, that brings me to the Phillips curve. Back in the 1960s, we had this trade-off between unemployment and inflation. But we aren't in the same world now. In the 1970s, that relationship between unemployment and inflation broke. We had stagflation. We had both high unemployment and high inflation. How did that work then? So then we ended up with this inflation expectations theory of Phillips curve. This expectations adjusted Phillips curve, which basically said that if people believe there is going to be low inflation in the future, then they won't ask for high wages, will they? It seems to me we might have succeeded rather well on that one. But it's not the same world now. The economies of the 1960s had credit controls, had exchange controls, had capital controls. We were on a gold standard. We had big unions. We had heavy industries. That's not what we have now. We have open economies. We had this huge shock from lower income workforces in the Far East competing with us for wages. We had this huge shock from countries in the East being able to export huge amounts of cheaper imports to us. We've had atomization of the workforces, destruction of unions. We've had the demise of heavy industry. We've had all manner of changes. We've got an aging population. We've got the entry of single mothers and sick and disabled and older people into the workforce. All sorts of things that all of them interfere with the Phillips curve relationship, if it ever existed at all, really. So is it rational to believe that in open economies with flexible labour forces these days, low unemployment must mean high inflation? I fail to see really these days why it should. Interest rates. If most bank loans are being used for asset purchase, is it rational to expect that adjusting the cost of borrowing would simply affect consumer price inflation? After all, if you buy an asset with a mortgage, you've committed a fair amount of your your spending power to servicing that mortgage, not to spending. I'd venture to suggest that actually when you have a very mortgage-based economy, there is considerable downwards pressure on consumer spending, just naturally because of the existence of mortgages. And the fact is that we now have far more mortgages in our economy than we had in the 1970s. Fiscal dominance, this is a good one. This is the idea that when the central bank when you've got an out of control government that's spending like there's no tomorrow and the central bank is monetising it all because it's got no choice, then you will have runaway inflation. And there are examples of that even in the world today. But why is it rational to think that there is fiscal dominance if the central bank is monetising government spending, but not if the central bank is offsetting harmful fiscal consolidation that is hurting the poor and causing disinflation? Because that's what we've had in the last decade. And nobody said, hang on a minute, central banks are spending all their time offsetting what governments are doing rather than meeting their mandates. The dominant target for most Western economies in the last 10 years has not been inflation. It's been deficit to GDP and debt to GDP. And those have been what have been driving the political agenda and therefore what have been driving the monetary agenda as well, though central banks may not have realised it. There's a theory called the fiscal theory of the price level, which was an attempt to get away from the idea that everything's about monetary policy and then saying, well, actually, it's the stance of the fiscal authority that matters, which is kind of related to this fiscal dominance thing. And to control their idea of controlling inflation is not the central bank should control interest rates so much as that the key to this is controlling the level of debt to GDP over the long term, and that therefore governments should commit to future primary surpluses that will stabilise the level of debt to GDP and therefore preserve the purchasing power of the currency. Yeah. How rational is it to expect that to happen when your electoral cycle is 5 years long? It pushes us back towards the idea that you have to get away from democracy, away from the idea that a population is sovereign and the population has the right to choose its own path to hell. We're back towards independent fiscal councils and quasi-fiscal central banks and debt breaks and fiscal rules and all the rest of it. Even if you have laws like debt breaks and balanced budget requirements that force governments into this fiscal straitjacket, future governments, well, future parliaments, certainly in the case of Britain, can always repeal those laws, can't they? It's ridiculous to say that your control of inflation rests upon an indefinite commitment to running primary surpluses sufficient to guarantee the future purchasing power of the currency. And yet, governments do stabilise the purchasing power of their currencies over the very long term. And it's not central banks that do that, because actually central banks doing that is a relatively recent thing. Historically, it's been governments that have done it. So my final question is, if government can't be trusted not to cause runaway inflation, why is it rational to believe the central bank, which in the end is mandated by government, is a servant of government, and can, in extremis, be taken over by government, can always and everywhere be trusted to control inflation? Surely, if you have a corrupt and profligate and malicious government that needs the central bank to monetize its irresponsible spending, the first thing it's going to do is take over the central bank. And that brings me to my final point, really, and there's a very nice, pretty picture here, which looks like I made it up, and I assure you I didn't. Inflation control ultimately is all about credibility. This chart is actually Venezuela, because every time I talk about central banks and governments and inflation and money supply, and particularly when I talk about QE, I get a load of people shouting at me about Venezuela and how awful it is. Venezuela's had hyperinflation since about you can see here from about 2017, though there was a bit of a blip before that. And it shows really little sign of ending. And the reason for that is that the Maduro regime is still in power. This, of course, is hyperinflation, which is extreme. Hyperinflations tend to be associated with extreme political events like wars, like chaotic regime change. When you have a malicious and venal government that is hell-bent on trashing its supply side and to pay off its cronies, then it's not uncommon for people to simply decide they don't trust that government anymore, and they don't trust the currency that it issues either. Zimbabwe is probably the most obvious example of that. To this day, the Zimbabwean dollar is not trusted by the people of Zimbabwe. They trust just about everything else, but not the Zimbabwean dollar. And the Venezuelan hyperinflation is in part due to the fact that Venezuela is dollarizing like crazy. People say would rather use the dollar, the US dollar, than the bolivar. And the more people move away from their own currency towards someone else's, the more likely it is that their own currency will hyperinflate. And that's a lot of what's going on here. So what we've got is a government that isn't credible, and a captive central bank that also isn't credible, and a population that says, I'm sorry, we don't trust you anymore. We're not going to use the currency that you issue. So my final point about inflation is always and everywhere a political phenomenon. This is hyperinflation, but actually this is true even just with ordinary inflation. The ability to stabilize inflation over the long run is to do with credibility. Is to do with, do you have a responsible government that is acting in the best interests of all its population? And if you don't, then you're going to have problems with inflation that is persistently too low, or inflation that is getting too high, or whatever, because your government is serving the interests of one sector of the population and ignoring another. So if you want to have inflation control over the long term, we don't need more independence of central banks. We actually need central banks and fiscal and governments to cooperate much better than they have been. But above all, we need a better quality of politician, because in the end, if you want to control inflation, you need to have good politics. I'll leave it there.
Thank you very much, Francis, for your talk, where you've been questioning a number of conventional propositions about the cause of inflation, ending up with this notion of trust, and this may be something for our conversation later on where is the line between credibility and a lack of credibility of politicians. But now it's time for Scott. Fullwiler, the floor is yours. The title of the talk is Some Reflections on Prices, Inflation, and Macroeconomic Policy.
Okay, I'm going to go in I'm going to take a different angle on this than Frances did in her excellent presentation, which isn't to say I disagree at all. It's that I went at it from a different angle. And watching her presentation, I noticed all the things I've forgotten to put in. So, but we can have those discussions later. So, hopefully it's not distracting. I have a cat here on the desk. And if I put her on the ground, she'll just get back up, and I don't have a door to my office. So, so we'll just have to live with that. Anyway, let's get right into this. I was going to do the little disclaimer that I might need to do anymore. I'm not necessarily speaking for all of MMT with this. Anyway, set some context, which, again, I think Frances already did very nicely. Central banks are wondering how inflation works because of all of the efforts they've taken the last 12 years, 20 plus years in some cases like Japan, to create inflation that hasn't happened. Many of you probably already saw, what was this now, 3 years ago, where Daniel Tarullo, as he left the Fed, sorry, there we go. As he left the Fed, remarked that the Fed didn't have a reliable theory of inflation and so forth, which again is consistent with all of this. Okay, so that's some of the context. What I really want to get into is some issues of measurement, and the core point, one of the core points I want to make here is that the price level of economic theory cannot exist in the real world. It's necessarily a social construction. We have this nice price level in all of our little models that we make and so forth, and there's no way that you could construct a price level that is theoretically pure the way that you have it in those textbooks. In the real world, what we have is prices being set and some agency of the government collecting data, imputing some of the data to get some imputed prices. We have them weighting the prices into a price index, and the growth rate of that price index is called inflation. At every step of the way, there are policy and or administrative decisions being made about which prices to measure, whether or not to impute, how to weight, and so forth. There are always decisions being made on that are unavoidable. So I'm going to just do some highlights of a number of pieces of literature that I think in general all of the ones I have are published by the Fed. Anyway, post-Keynesians won't find this surprising, institutionalists, etc., that these researchers at the San Francisco Fed found that that more of the price, the core PCE, is acyclical than procyclical. So if we're going to be talking about whether or not a central bank can control inflation, by definition, we're saying what's the price index that they are attempting to control, what prices are in the price index, and how does a central bank affect those prices. A deeper dive into sort of more granular or finer level prices within the price index gets essentially the same result. You get some differences, but largely you get a very similar picture. that the acyclical parts of the price index are significant determinants of the price index itself. This is from the earlier author I was looking at from the San Francisco Fed. This is a newer one looking at what was going on during COVID. Up there in the bottom, or down there on the bottom left, he's looking at prices, changes in price and quantity for goods and services during COVID, and probably looks a lot like you've already been seeing in terms of which prices are falling and rising. And noticeably, of course, vast majority of the prices fell, which is interesting since we had both a supply shock and a demand shock here. And since the supply shock was people don't go to work and produce things, and then, of course, some supply chain shocks and so forth. Then what he does is he categorizes it by supply and demand effect, which ones are contributing to supply and demand, supply versus demand, and which ones are more sensitive than the others in the price index. So anyway, the qualitative or quantitative results there aren't as important for my presentation as much as that quote there, whereas the key assumption of the methodology he's using is that inflation dynamics are best explained at the categorical or sectoral level. Ample evidence in the literature that this assumption holds, and so he walks through some of the others that have found that, meaning if we're going to go look for inflation, we in the real world we have a price index, and it doesn't mean that the price index we have is perfect or can't be improved upon, or might be deeply flawed, whatever. The point is, inflation is going to be measured by a price index. Now, this one is interesting because of the note that core PCE in the U.S. has been driven significantly by the way that housing is measured, the housing sector prices is measured. As it says, collectively constitutes about 44% of cyclical core PCE inflation. And if we look at this, the most significant part of that is the way that rents are measured. And what I have up there in the pie charts is about 24% of CPI is from this rents measure, and even more than that, a greater percentage, is if you go to core CPI. 11% of it, the PCE has a smaller share. Anyway, again, consistent with the theme here of collecting price data, imputing it, whatever, citing the weights, underlined in red is an explanation of some of the, at fairly high level, rather than digging into the details of how that calculation is done, but sample weights according to their shares in either owner-occupied or rental market, so forth, and the decision of whether they include utilities, so forth. Okay, a little bit of theory. I'm going to have to go quicker on this than I was intending, but the late, great Fred Lee, whose office I now inhabit at UMKC, had a very nice post at New Economic Perspectives a few years ago. Well, not a few years ago, 7 years ago. Just a few pages, where he's arguing that the conventional price mechanism of, as you might call it, market clearing or whatever, is not how markets function, and it's been known that they're not how they function for a long, long time. And so he walks through a summary of how prices are set in, in goods markets, prices are set, or wages are set, and lastly, interest rates and how they matter or don't matter so much for investment spending. And essentially arguing that if this is the case, why are we using frameworks, and why do we have it as sort of our starting point that we have a price mechanism as in traditional supply and demand analysis? And for where I'm going with this, the key point is, again, this is supporting the idea that what we're after is a understanding how a price index works in the real world, and the one that understand how the one that we're using works, rather than the traditional one of there's an aggregate price level versus relative prices dichotomy. Nathan Tankus did a nice piece a few years ago in a similar vein. In the interest of time, I'm not going to read all of that, but as he says in there, I'll just read about 3 lines down that I haven't read. So the consumer price index grew 3% faster. So what? Does this say something about the value of money in general, or did 6 industries increase their target profit margins? Did product quality change significantly? So forth, so on. So the sort of underlying framework that I use is, or I base my analysis on, is that the nature of prices is inherently legal, regulatory, administered, budgetary, and I think this, I don't want to speak for Francis, but at least for me, it seemed pretty consistent with the idea that it's always, inflation is always a political phenomenon, right? But if we look at the things I have on this slide, there's quite a bit of influence of legal, regulatory, administered, budgetary, right? That and frankly, you can't really have a price without some influence of one or more of those. I think one of the really interesting ones where I have down there involuntary unemployment, right? That the way that we in the traditional models worry about inflation is by worrying about whether involuntary unemployment is getting too low, and thus wages are growing too fast. At least in the models that we see, there's not really a question of whether or not it's a bad thing for government or central bank to be attempting to, in effect, control that price, right? And so when sometimes people talk about MMT, promoting, say, price controls or something like that, my response is we already have price controls. Intellectual property protections are effectively a form of price controls. Energy, agriculture policy, price controls all over, housing rent policy, and so forth. Certainly interest rate policy. Antitrust policy, all of those things are a form of price control. And what we're really talking about is, as Francis said, putting democracy more into that process. Okay, let's see here. So I've got a few examples of this, and I think in the interest of time, I'm going to go quickly through them. But they're basically examples of the inherent political nature of prices directly influencing price indexes. So this is an antitrust policy example. This is an example of, in the U.S., the Affordable Care Act, which slowed the growth of Medicare payments, which then slowed the growth of the medical component of the price index, or the price indexes that are being used, and has contributed significantly to keeping inflation low in the U.S. And what I would say on that one, particularly, this is sort of the cyclical acyclical dichotomy, is if medical prices are falling, is there anything a central bank can do if medical prices are rising, let's put it that way, is there anything a central bank can do to offset that, or that they really should do, right? Because how do they offset it? They'd have to slow down the economy enough so that the cyclical prices fall enough to offset that, right? And that's the sort of thing we should be thinking of as to whether or not it's desirable for a central bank to be controlling inflation, much less whether or not they can. Okay, so this is a look at parts of the price index and how much they've risen over time. And it's notable that the ones that are rising faster, or at least most of them, are either the things that are more directly related to direct pricing in public policy, or imputation, such as in shelter and so forth. Then we also see Japan, of course, having all these problems creating inflation. But they have a number of things in their price index that via policy they are actively decreasing. So if they're affecting a reduced growth rate of the price level, and effectively, as the article says, undermining their own efforts to boost inflation. Okay, a bit on policy, and these are some reflections. Nathan Tankis's piece has this wonderful quote from Keynes in the General Theory about price indexes, and our precision will be a mock precision if we try to use such partly vague and non-quantitative concepts as the basis of quantitative analysis. So what's the point of policy and the price index? Well, first off, think about this. What if a cure for cancer raises inflation? Right? First off, how does it raise inflation? Well, it raises inflation because the design of the price index and the way that the prices are gathered leads to a decision that the price increase is bigger than the quality increase, or the balance of the price increase versus the quality increase has led to an increase in inflation. And that in and of itself is interesting because, as Keynes was saying, it's kind of hard to be quantitative about some of these things. And one of the things that's inherent in a price index is determining what is a price increase versus a quality increase. But another one is, what if a cure for cancer raises inflation? Again, what's the appropriate policy response? Is it for the central bank to raise interest rates? Is it to raise taxes? Maybe it's something else, right? If prices are rising faster in communities with larger concentrations of the historically marginalized and disenfranchised, what if these prices are not heavily weighted in the headline core, trimmed mean, median price index, whatever, the sorts of statistical manipulations that are currently being done, at least across the Federal Reserve, to sort of more perfectly tease out of the price index the true path of that it's taking. But what if these are not heavily weighted? Then they don't become part of policy. And maybe it's not the average price index that you use, but you also have other indicators. So you don't rely completely on an inflation indicator, but you rely on various different types of price indexes. So for instance, the disabled, right? If inflation's rising 2%, somebody who's disabled or has a chronic medical condition, that's not the reality they're facing. And that's should still be important for policy. On the other hand, what if these prices are heavily weighted, right? Again, is the appropriate response to raise interest rates and slow down the economy in that case? Lastly, is it a coincidence that excessive wage growth is historically the main thing economists and central bankers worry about in terms of driving price increases? A few thoughts, gonna have to be quick again on some policy options. These are certainly not exhaustive by any means, but a long time ago, well, I guess only 5 years, I wrote this short piece on replacing the budget constraint with an inflation constraint. So if we're going to talk about fiscal policy and creating an active role for fiscal policy, and by that I do not mean fiscal dominance, as Francis was explaining. I mean a fiscal policy as a partner, a necessary partner, because it does different things than monetary policy and has different effects on private sector financial positions. but a partner that contributes to keeping inflation at a target. So the current practice at the Congressional Budget Office in the U.S. is whenever there's any policy proposal, they project the deficit effects of it only, while assuming unemployment converges to its natural rate within a year or two, assuming real GDP converges to its potential path within a year or two, assuming inflation converges to a low rate within a year or two, and that the Fed is just setting an interest rate on the government debt, which of course is basically embedding assumptions that nothing will go wrong, and we just pull a deficit estimate out of that. And that's about the most worthless projection that could be made, and it's not surprising they've always been wrong, although of course these sorts of projections are inherently difficult to make. A better way to do it would be project pricing effects of policy proposals, connect those to price indexes. Then a necessary pay-for is the rise in the projected price increase. The possible pay-fors can go well beyond taxing and spending, consistent with how the price indexes are actually work, and creating measures to monitor in real time. I'm going to skip that. This was just a quick slide on, I did some work with Indonesia a few years ago, and it's very interesting. They have this inflation control team, national control team, and then they have it down at regional and city levels. And their inflation control team includes all sorts of ministers within the government outside of the central bank. And if you've been following the news in Indonesia, it's even their policy making end of this has expanded into beyond the central bank in terms of responsibility for inflation targeting. What to do policy-wise? Well, one of the things would be to have a lot of automatic stabilizers in there. Again, in the interest of time, I'm not going to go through those. Central banks, people might be surprised, central banks have a lot to do in MMT, particularly financial stabilization. In the U.S., at least, the last 4 business cycles expansions have been driven by financial asset price increases. I just want to hit the middle point there, the middle bullet there. What the government and the central bank allow during the expansion to happen, they will take onto their financial statements in the next crisis. The government will have to bail it out with income. Central bank will have to take it onto its balance sheet, say, like it did in 2008, 2009, like it's doing right now or has been doing, where it's taking on corporate it's lending to corporations, and well, it should be lending more to municipals and so forth. So let's go to conclusions. As Francis was discussing, and I didn't really, except for my first 2 slides already, I think what we need to do is, one of the things we need to do is make sure that we are not falling back onto your traditional explanations of inflation when we are looking at alternative approaches to analyzing the economy. MVPY, Phillips curve, unemployment's lower, all those sorts of things. Those are not settled or uncontroversial right now. But a lot of the critiques I see coming at us in particular are based on the opposite. As I said, there's no theoretically pure price level in the real world. Prices are inherently legal, administrative, regulatory, budgetary. Replacing the budget constraint with an inflation constraint broadly implemented is at least one of the ways to design a fiscal policy or to design fiscal policy that is consistent with inflation targeting and also recognizes that we don't want these arbitrary fiscal rules that aren't related to macroeconomic outcomes, and recognizing inflation is in itself inherently value-laden. So if you thought the very best thing in my presentation was that picture on the first slide, there it is for the end. Thank you.
Thank you very much, Scott. Thank you also for taking the discussion to the big questions, measurement of inflation, of the price index, what it means when the central banks target a certain number. And also you seem to suggest that the target should disappear from the public radar. But in another way, you suggest to introduce an inflation constraint with fiscal action. So this might again be good for more discussion in the Q&A part of this session. To move to Karl Whelan, the title of his talk is some thoughts on do central banks control the price level with a question mark.
Yeah, apologies for the bland title. I was asked to comment on what my thoughts on do central banks control the price level is, and unlike Francis, I couldn't come up with a clever title. I apologize in advance as well. My throat is a bit scratchy. I'm developing a little bit of a cold. I hope not to be coughing and spluttering my way through the talk. Okay, let me say a little bit about my background. That influences what I'm going to say here. So we're going to talk about central banks. I spent half my career, half my professional career as an economist, working for central banks. I worked for the Federal Reserve. I worked for the Central Bank of Ireland, which also meant I spent a lot of time at the European Central Bank. And the other 50% I spent as an academic, but I still do a lot of consulting and advisory work. So I think a lot about central banks. And in terms of this question, I would say for most of the last 40 years or so, if you ask that question, then the answer from most people, most macroeconomists, most central bankers would be, well, yes, of course. Central banks have a huge influence on the price level. And you can find loads of examples where macroeconomic policy, largely implemented by central banks, have produced high inflation, and where they've ended high inflation. So, to give an example in terms of Europe, prior to the euro, you could link the relatively high rates of inflation in countries like Italy to the behavior of the Banca d'Italia, to the monetary regime, which was seeing lots of regular devaluations, and versus in Germany, you could see the low inflation rate was linked to the monetary policy of the Bundesbank. We could see that, in the United States, the appointment of Paul Volcker as the chairman of the Fed, his determination to reduce inflation ended up being successful at significant cost. So most people would have thought this was a bit of a funny question. But these days, as has already been discussed, central banks are struggling with inflation in a different way. They've largely set inflation targets to be something on the order of 2%. They have decided that pure deflation, in a situation of falling prices, is not a good thing. But they're failing to meet those 2% inflation targets. And they're failing to do so despite having implemented policies that, the central bankers of the 1970s and 1980s would have thought were incredibly radical. All these unconventional monetary policies. So in central banking circles, there's now all these discussions about, well, do we have the ammunition to be able to get inflation back? Is this something we can do? So it used to be a sensible question, but people now are starting to ask whether or not this is. My answer would be yes, central banks certainly can influence the price level and can raise the price level and can produce higher inflation. But what we're seeing is the current environment, and it is, as Francis has stressed, it is largely a political thing. There are conventions in central banking in terms of how central banks are constrained, and also the current conditions in the global economy that are constraining them from taking the actions that would, ultimately be successful to get inflation back on target. But I don't think that matters that much that the central banks are constraining themselves. There are other ways that we could get inflation back on target, and that's through the use of fiscal policy. But again, as I'll discuss, there are various social conventions and political conventions in place that are preventing us from using fiscal policy as we should be doing. Okay, this is sort of a roadmap for the talk. I'll just talk a little bit about micro price theory versus macro price theory, sort of set a background. I'll talk about why central banks, as opposed to other arms of the government, have been charged with controlling the price level. A sort of a potted history of economic thought in this area as I read it, and then I'll talk about the current situation that we're in and where we can go. Okay, a lot of words on here, but I just want to sort of make a relatively simple point, which is right now there's an interesting dichotomy between microeconomics and macroeconomics when we think about the determination of prices. I'm a macro guy through and through, but I know lots of empirical microeconomics. I get the impression from all the seminars I go to and the research I read and Nobel Prizes I see awarded and so on, that empirical microeconomics is a pretty successful discipline. And you see study after study, that confirm that prices of things are largely a function of three things: demand or supply or market structure. How demand and supply Now it's possible this last point, the market structures, there's an interesting debate to be had about whether or not changing market structures are doing something to suppress inflation. But to be honest, the evidence I see about changing market structure suggests that there's increasingly less competition, and you've got all these super firms controlling things. And if inflation was high, I wouldn't be surprised if people were looking at that and saying that's a reason why inflation is high. So it's not obvious to me that that's playing that big a role. So I think ultimately prices at the aggregate level and that's all a price level is. Scott had some interesting details on exactly how they put the price level together, exactly how the sausage is made. I recall my days as the price analyst at the Federal Reserve, spending lots of time on owner's equivalent rent and all that good stuff. But ultimately, any price index that we look at, any price level, is an aggregation up of individual prices. And all of those individual prices, ultimately, I believe, are being set based on a balance of demand versus supply. So if macroeconomic policy can influence aggregate demand, if it can get people out there spending, then they're gonna raise them ultimately at some point. So why, if it's that simple, why are central banks and macroeconomists so confused now about what's going on? Get at that, and to get at why it is that it's central banks that are being given this authority, I'm going to give this short intellectual history. And what I'm going to do is highlight two key contributions from Milton Friedman that I think have had a profound influence. So one is the idea of monetarism. We've already had the quote. Inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money. Now, Friedman says this, but that doesn't make it true. What's the actual logic here? I mean, at its simplest level, the idea behind monetarism was that somehow the price level, aggregate price level, sort of tells us what the value of money is, how much stuff we can buy. And therefore, we increase the supply of money, then, without increasing supply capacity, we'll end up reducing the value of money. And so somehow that raises the price level. Okay? Too much money circulating, purchasing goods and services, ultimately all that happens is prices go. Now, you think about it, it's sort of some way credible that there could be a relationship like this. But, think about what the definition of the supply of money is. M1, currency plus deposits. So if a bunch of people in an economy, in a country, go and sell, let's say, their foreign property, and they get cash in return for that, and they keep that cash on deposit in their account. The money supply has gone up. Their wealth hasn't gone up. They've swapped just because they have more money in their deposit account, does that mean that they're going to go and spend more money? Not necessarily. Friedman actually had something to say about this. He had a bit of a theory for why the process by which, if you create additional money, additional cash or additional money in deposit accounts, why that would propagate throughout the economy. So at this point, he's basically talking about cash. So money growth raises the amount of cash that people and businesses have relative to other assets. So if they have all this cash, there's too much cash, people try to get rid of the cash by buying other assets, and it bids other assets. Okay, it's a sort of a hot potato sort of a theory, right? There's only so much cash. Each individual is trying to get rid of their cash. You know, I don't know how that this is really actually that telling a mechanism, but it was hugely influential in the 1970s and the 1980s. But history has not been kind to this idea, that ultimately inflation is driven by money growth as defined by M1 or M2 or any of the M's. In modern advanced economies, the cross-sectional relationship that you see over long time periods is quite weak. You know, if you have average M1 growth of 10%, you see countries that have that with no inflation, you see countries that have that with 20%. Even easier probably to see within countries. So here's the United States. The blue line is the growth rate of M1. The red line is inflation. I think it's just about possible during Friedman's popular era in the 60s and 70s to sort of see possibly how, if you were going to account for his famous long and variable lags, that there might have been a relationship whereby when the blue line goes up, the red line goes up a little bit afterwards. I could just be seeing things. What's pretty clear is over long history now, we haven't seen such a relationship. And quantitative easing episodes, which have generated significant increases in not just the monetary base, but also the M1 money stock, have provided us with some pretty clear natural experiments to discredit this idea. But it was enormously influential throughout the 1970s and 80s in focusing both in terms of legislation and in terms of politicians and who they looked to in terms of, who's going to control the price level, to put that onto central banks. And I think this was the sort of first major step towards central banks becoming this body that we charge with controlling inflation. The other big idea from Milton Friedman, which has already gotten a bit of an airing, is the expectations augmented Phillips curve. So Friedman's famous 1967 presidential address was the American Economics Association. There's no equations in it, but if you read it carefully and read the footnotes, you can basically see he was proposing a model of this sort. So Keynesians in the 1960s thought there was this trade-off between inflation and employment, and you had to pick a spot. But that didn't make sense to Friedman. Friedman thought that the unemployment rate is a real variable, and it should be consistent with any possible level of a nominal variable. You could have a steady inflation rate of 10%, and if everybody knew that, and inflation, all the prices and contracts all had things going up 10% every year, then you could do that and have the unemployment rate be the same as if it was 2%. I think that's a reasonable idea. So Friedman's critique of the Phillips curve then was you had to augment the basic Phillips curve with inflation expectation. So two things could drive inflation: the unemployment rate, the real economy, and then this inflation expectations. And Friedman was not an advocate of rational expectations. That came a bit later, and it was not a thing that Milton had a lot of time for. But his 1968 paper was very clear that people's expectations adapt over time based on what they see going on. So if, for instance, central banks or governments were trying to use the Phillips curve and were trying to pick a spot with low unemployment and high inflation, eventually the inflation expectations would adjust upwards. Okay, and basically he said, on average, you're not going to fool all the people all the time. So by and large, you're going to have inflation expectations and inflation being about the same thing, which means on average, you're going to have unemployment be at its so-called natural rate. Okay, another concept that he introduced. So with this kind of framework, you're not going to get on average unemployment to be lower than, than U star. So you might as well instead just focus on having low inflation because there are costs associated with it. We're not quite clear how big those costs are, to be honest, and there's certainly no theorem that says that somehow 2% is the optimal level, and if we go over 2%, we're on some slippery slope. There's very, very little research on thinking about the question of an optimal level of inflation. But certainly people don't like it when it's high. So you can't get away from unemployment equaling its natural rate, was the theory on average, and so you should focus on low inflation. Friedman predicted that the original Phillips curve would fail, and that was a good prediction. This is a scatter plot, and every box here represents a quarter, and it represents the combination of the data on inflation, which is represented as the 4-quarter percentage change in the GDP deflator, and the unemployment rate. And if you think you can see a pattern there, then your eyes are fooling yourself. You're fooling yourself. The correlation here is basically exactly 0. But if we remember, Friedman gave us the idea that there was adaptive expectations. So gave us a sort of a potential formula we could use. So here you could say, okay, what if people used exactly the inflation rate from the previous year? Okay, so in 2019, people looked back and said, what was inflation over the past year? That's what we're going to use going forward. So you could, the model with that goes from being this sort of will o' the wisp, right, relying on this thing we don't see, these inflation expectations we don't see, to something sort of concrete, right? So this is a change over inflation depends upon the unemployment. So I've implemented that with the same set of dots. Okay, so with the same set of dots, I'm looking at the 4-quarter change in inflation, and I'm looking at the unemployment rate. And this goes from 1955 up to 2009. And, this isn't bad. For such a simple model, this isn't bad. And nobody ever really pretended necessarily that Phillips curve models worked very well to explain things like food prices or oil prices, energy prices, or administered prices of some of the things that Scott talked about. So for a simple economic model, this thing isn't bad. And I can certainly tell you from my time at the Federal Reserve in the 1990s and early 2000s, implicitly this kind of model and economy is what a lot of central bankers at the Federal Reserve were using. This is how they thought about the world. Their empirical models are based on slightly elaborated versions of this correlation. Now, this has a lot of implications. If this is how you think the world works, you think the world works like this, that unemployment can be below its natural rate, but if it is, then inflation will increase. And it can be above, and it'll make inflation decrease. Most central bankers then thought about this but in theory, there is something to exploit here. We could, as a government or a central bank, try to have low unemployment. But if we try to keep unemployment low, then, suppose we keep it low enough so that inflation increases by 1%. Well, then if we start at 2%, we're going to have 3%. Then we're going to have 4%. Then we're going to have 5%. In fact, if the underlying model is the adaptive expectations Phillips curve, it's probably worse than that, in the sense that if the pattern of inflation is it goes from 2% to 3% to 4 and to 5, what's the next number in the sequence? It's not 5. This version of it says it would. The people would assume 5. So people would react. So you could keep unemployment below the natural rate if you want, according to this theory, but all you'll get is ever spiraling inflation. So the best outcome for most central bankers, the way they would think about this is don't bother trying to exploit this. Let's just try and keep unemployment near its natural rate. Let's just try and keep inflation stable. A whole raft of things then follow from that. Right? First thing is, if you And, you know, probably the peak of this idea was occurring in the late 1980s, early 1990s in academic circles. And this whole idea about academic scribblers and the influence that they had, those are the people that gave us the Maastricht Treaty. And so they've given us the structure of central bank independence that the European Central Bank now works with. And it will be very difficult to ever change it. This also gives you inflation targeting. This is all about trying to anchor inflation expectations. So we want inflation to be low, and so the independent central bank, we make them more credible, and the public believes this. Give them an explicit inflation target. The public will set their inflation expectations equal to this target. De-emphasizing fiscal policies during this whole era in the 1990s and prior to the global financial crisis of 2008, the emphasis was always on monetary policy, not fiscal policy. See people say fiscal policy was kind of clumsy, and kind of cumbersome. It would be dangerous. You would spend money on things during recessions, and then the programs wouldn't get scrapped afterwards. And you just again, you don't want to trust fiscal policy. And then of course you had to keep monetary and fiscal policy completely separate, right? Rather than acknowledging that the government has a single unified budget constraint that involves both monetary and fiscal elements. You wanted to sharply cut those things off, because otherwise you end up perhaps having the central bank using these money creation powers to finance government spending, and again you're off to the races, which you're going to have inflation out of control. So essentially I'd say I think this one equation leads via its logic to these 5 developments, all of which we've seen have huge influence. Alas, the equation doesn't work very well anymore. This is that correlation, right? This one here that used to look pretty good. This is that correlation over the past 10 years. And it's 0, basically. So there's been no correlation in the United States, and I would hypothesize in many other countries, between the level of the unemployment rate and the change in inflation. In fact, this is the rolling 10-year average for that correlation. So we run that chart over rolling 10-year windows, and at the end of the window, we go and calculate the correlation. And what we can see is, right when they were formulating the Maastricht Treaty, around 1991, this was the highlight of expectations of adapted Phillips curve, expectations of augmented Phillips curve. This was the highlight of this as a correlation. It worked really, really well for a while. And then we implement all of these things that are based on its predictions. We get independent central banks, we get inflation targeters, we get no monetary financing. All of this great stuff happens, and the correlation that it's all founded upon disappears, which has a sort of a Lucas Critique kind of funny irony about it. So the Phillips curve has had a bad decade. What next? Do we ditch the Phillips curve? Well, central bankers are working very hard. I mean, one thing you can just say is this is just a bad model, right? You'd be surprised it worked so well, for so long anyway. But ultimately, if you take it back a step and say inflation is being determined by the balance of supply and demand in the economy, why you think the unemployment rate is just going to work as this summary statistic for all of these complex forces in the economy. Like, it'd be great if it does, but it seems it doesn't. But central bankers are not ditching the Phillips curve. They're instead doing very elaborate exercises to try to explain its failure. And they always involve these, again, I call it will o' the wisps. They involve these things that we can't see, but they must be doing something, right? So one of these is inflation expectations. The one explanation is correlation doesn't work anymore because we were too successful in anchoring inflation expectations. And now they stay low no matter what happens. So even when unemployment is low, people still just think inflation is going to be low. Which of course raises the question, how do you influence inflation expectations if you think they've gone too low? Not a lot of good answers on that. Some research out, I think this week or last week, by macro superstars, Emi Nakamura and John Steinson and co-authors, basically pushes this as a theory. It says that the coefficient on the unemployment rate hasn't really changed. That's not the issue. It's that inflation expectations just have become increasingly anchored at low levels. That's what's going on. The other will of the wisp that gets rolled out every so often is a falling NAIRU, a falling natural rate. basically, I'm old enough now to realize that in every economic expansion, when the unemployment rate gets low and inflation doesn't take off, central bankers then go and DBO and all of these bodies go and say, oh, actually, the natural rate of unemployment is lower than we thought it was, just like in the last time we had an expansion and just like the time before. I don't think this is ever linked to anything, actual theory of structural change in the labor market that ultimately justifies it. Now, look, central bankers, central bank academics and so on are still, Phillips curving away and trying to save the thing. But I think what we can say is that the Fed has basically abandoned the Phillips curve and also the Taylor rule as a way of setting policy. The Fed's decision to reduce rates prior to COVID, even though the unemployment rate was very low, was basically the end of the Phillips curve as having a lot of practical influence at the Fed, at least for now. And the failure of the Phillips curve isn't the only thing that's perplexing modern central bankers. What they're also perplexed by is they're providing this enormous stimulus, zero interest rates. They're giving forward guidance that they're going to keep those interest rates at zero forever. They're going out and making huge asset purchases. They're doing way more stuff than their predecessors ever did, and not a peep. It doesn't seem to budge inflation. So that brings in the other will-o'-the-wisp, which I'm more inclined to think is a real phenomenon, which is the equilibrium real interest rate. So macroeconomists, they now reckon that the equilibrium real interest rate in the economy is much lower than it used to be. So even a zero interest rate doesn't really stimulate the economy like it used to. And there's various theories for this: demographics, weak productivity growth. The famous Slovak-Williams model economy that's updated every quarter by the New York Fed gives this sort of real-time estimates of what they think this natural rate is, and we can see it's now down at around zero. That has influence on the FOMC, not least because John Williams is the vice president of the FOMC. But we know the FOMC thinks that the equilibrium real interest rate is lower because they have to give forecasts now in recent years of what they think will happen with the Fed funds rate and what they think will happen with inflation. And back in 2012, the gap between their forecast for funds rate and their forecast for inflation was 2.25%. As of June, it was 0.4%. So central banks now believe that the equilibrium real rate is very low, which means that the stimulus that they're giving from low interest rates isn't nearly as much as it would have been in the past. Okay. All of this combines give this sense of being out of ammunition. The ECB, to its credit, has introduced a negative nominal interest rate policy, but other central banks, the Fed and the Bank of England, for example, are not willing to do that. There's the asset purchase programs. The asset purchase programs, loads of research on this and what they do. But, Bernanke's old joke was, QE works in practice, but not in theory. But the theory, the sort of arbitrage pricing theory, rational expectations, arbitrage pricing theory that he's sort of poking fun of, it's not that wrong in the sense that the amount, this quantity of purchases that you have to do to get relatively modest impacts on bond yields and asset prices raise a lot of questions, because you see this enormous increase in the balance sheet of the central bank, which inevitably proves to be controversial. You don't get a whole lot for it. Forward guidance was a big thing a while ago. Not that big a thing now. Telling the public you're going to keep interest rates low for a long time, sure they know. So what are you left with? We've moved on largely to what I call open mouth operation. So the Fed comes out now and says, yeah, that inflation target, we've reviewed it, and it's not we get to 2% and it's job done. We wanted to average 2%, so we wanted to spend time above 2% as well as below 2%. But why would anybody believe that? As Francis mentioned already, why would we believe the Fed is going to have inflation of 3% when it's failed to get inflation up to 2% over the past couple of years? It's not as though any other policies are being announced that are, other than more of the same, that's going to implement this. Okay, I think this is all a form of institutionalized, engineered, learned helplessness. Policy options clearly are available. For example, helicopter drops. Right? I think everybody would reckon that if the central banks around the world just place an electronic credit of large amounts of money every month in every citizen's bank account, that ultimately that would increase aggregate demand to a point where it would outstrip supply to the point where the price level would go. Okay, and that is both intuitive, but also even in fancy, new Keynesian models, like the kind of things that Michael Woodford believes in, Jordi Galli believes in, that works as well. Jordi Galli has a very nice paper demonstrating in a pristine, micro-founded new Keynesian model that helicopter drops will drive inflation. But of course, they don't do this, right? They don't do it because how do you organize it? You probably have to, in some way, cooperate with the government, right? The central bank doesn't have, in most countries, they won't have the list of everybody's bank account. So it probably in practice ends up just looking like a FUD or looking like a stimulus check. And so then it's monetary financing, okay? And I think Article 123 of the PFEU is, I think, going to feature much more in people's minds in the next couple of years as a constraint on European policy than it has done up to now. So I think central banks could do it, but the institutional conventions about monetary financing are constraining them from doing it. What about governments? Well, you say, governments have lots of debt. Governments have lots of debt at the lowest interest rates in a generation. Interest burden of current debt levels, incredibly low. Central banks have engineered these incredibly low interest rates to the point where, we don't really need the helicopters. Central banks or governments that can borrow for negative yields to go and stimulate the economy should be able to do so on a sustained basis for many years now, and that should be able to. But of course, that raises the dreaded specter of fiscal monetary cooperation, which we were institutionally making very difficult. And in Europe, in particular, we run into the fiscal rules that are in the Maastricht Treaty suspended for the next year or so, but not forever. And while the definition of the equilibrium of what price stability meant wasn't written in as a number in the treaties, okay, so the ECB gets to pick this close to 2% thing as an interpretation of it. Alas, the numbers 3% and 60% are hardwired into the Maastricht Treaty, and I fear their malign influence will start to show up again, within 12 months. So these are examples of how, again, I think macroeconomic policy can, and central banks often can, control the price level, but political institutions can prevent them from doing so. Okay, that's all I had to say.
Thank you very much, Karl. Thank you for your talk, and also for sharing your experience at in central banking. And I invite again all registered attendees who would like to ask questions to our speakers to write their question in the chat and also raise their hand. We may try to give you the floor, or maybe I'll just deliver the question to the speakers. Indicate, please, which speaker you asking the question to. We do have a question from Jakob Steffen. And this is a question to Francis that in fact is touching upon something that Karl also touched upon in his talk. And the question is, this is a brief summary of a longer question. The question is the following, to Francis Coppola. The Fed is moving to average inflation targeting. And now, how does that affect your analysis of inflation expectations? Do you think the policy shift is useful? Question for Francis. If Francis should like to come in and address, sure, this question.
Sure. Sure. Well, actually, I think Karl's kind of answered it already. I talked about raising the inflation target, and in a way, average inflation targeting is kind of raising the inflation target kind of for a period of time to compensate for you not managing to meet it before. And I am on that where I was before, that if the central bank can't credibly convince people that it can even reach its inflation target, how is it going to credibly convince people that it can manage to allow inflation to run above target for a period of time to compensate for failing to meet it previously?
Thank you. Okay, so I'm looking into the chat to see if questions are coming, and there are a number of intersections, overlappings among the three talks that we've been listened to, even though from different standpoints, and one has been the integration, the coordination, or the lack of separation between monetary and fiscal policy. And I have a question to Scott about his approach to his proposed policy of introducing an inflation constraint into fiscal action. And just in very much in general, how would you see then the role of the central bank in coordination with a policy like the one you are proposing of introducing an inflation constraint into fiscal policy? What should the central bank do? Go.
Okay, thanks. So there's a number of things for central banks to do. I mentioned on the slide they can be responsible for managing or avoiding, say it a different way, managing financial stability. And many things they can do there. The main thing that you get, say, from a Minskian perspective, is to not use the short-term interest rate as the primary tool of policy. It doesn't mean that central banks aren't doing anything. So you can still be regulating and I don't mean regulating necessarily in the sense of regulation, but you can still be regulating the growth of credit and so forth in various other ways in terms of managing margins of safety, et cetera. Anyway, in terms of fiscal policy, monetary policy, in essence, you don't have to change much at all in countries like, say, the US, UK, Japan, et cetera, Canada, where there are liquid bond markets with the central bank normally being a backstop for the primary dealers or others that are the main actors in those markets. So there's not a whole lot of difference that you need. The main thing would be, again, if you're not targeting the short-term interest rate, you can take interest on the national debt. Sorry, if you're not manipulating the short-term interest rate, you're keeping it fairly low. You can keep interest rate on the national debt out of the transmission mechanism of monetary policy. You still have the ability of the central bank to adjust credit conditions, even adjust interest rates that the private sector is borrowing at, which is effectively what you're trying to do when you adjust short-term interest rates. You're just trying to do it through different channels. Another thing the central bank could do, and they do in a lot of countries, is issue their own securities. And there's absolutely no reason why the number of risk-free assets in the financial system should be exactly equal or let me say it, the increase in the number of risk-free assets in the financial system should be exactly equal to the size of a government deficit. The financial markets have a need for risk-free assets and really good collateral that may or may not have anything to do with the size of a government deficit or national debt, etc. And who is the entity that is managing liquidity and financial stability? It's going to be the central bank. So they are the more logical entity to be issuing the securities, not because trying to print money or anything like that. As Francis said, all government deficits are sterilized, either with a government bond, central bank liability, paying interest on a central bank liability, whatever. There. Hopefully I answered your question somewhere in there. I think you're on mute.
Issuing certificates of deposits is something that the ECB, for example, could do. It's in its powers, but they never did. And I think you mean securities that can be held by the general public, not just by banks, right? Yeah.
Yeah. Let me just say one more thing on this, because there's a little quick narrative here, which is, I think it's really weird that people have, and economists in particular, have a big fear of inflationary effects if the central bank is, say, directly financing the government, when of course we know that's sterilized if we understand these operations. But nobody seems to have a problem if the central bank is lending to the dealers that are lending to the government, which is the situation we have under normal circumstances already.
Right, right. We have a, do you understand, Andrew, you have a question? Andrew, what?
Would you like maybe to check Colin McCulloch first, Andrea? I'm happy to wait.
Okay. I'll go with Colin McCulloch question. This is a question for Francis and also other speakers who might want to comment. And the question goes like this: if money creation by commercial banks is only weakly controlled by central bank / government, and bank money creation is mainly driven by lending for assets, mostly private property, what is the effect of asset price inflation? Existing owners of property will have strongly rising net worth and less precautionary saving, even remortgaging, hence putting more into consumption, which could then be inflationary if reaching supply capacity limits. So should integrating monetary and fiscal policies as political acts include wealth taxes or transaction taxes on property, or more generally on net worth, not only as a distribution equality issue, but also as an inflation control money stability matter?
Well, this is an interesting question. I don't think there's been enough discussion really about the effects of widespread asset ownership. I would make a couple of comments about this really. The first is that in most countries, the acquisition of property is done through debt, and it takes a long time to pay off that debt. Your average mortgage is 25 to 30 years. So the property that is owned outright, or on which the mortgage is very small, disproportionately held by older generations who actually have less propensity to spend. I know this is weird, but they don't. They're often very concerned about their pensions and about their elderly care. And they want to help their children and things like that. So they don't actually necessarily go and blitz it all on Ferraris. There's also the question of, it's all very well saying you can remortgage or something, but actually you can't necessarily. It depends upon the availability of late mortgages for older people. And banks have loosened that a bit, but they're equity release products, they do tend to sort of clamp down on them a bit, precisely because they are a mortgage. They come out of the person's estate when they die, and people, like to pass things on to their kids. So I am not convinced myself that widespread outright asset ownership by an older population is necessarily that inflationary. That said, I think there is a good reason to have wealth taxes for other reasons, particularly to actually deal with the fact that we are moving towards a situation where we have abundant capital and many people are income constrained, and it makes more sense to tax the thing you have abundance of, not the thing you are short of. So I would like to see a general move towards wealth taxes and away towards capital taxes and away from wealth taxes, personally, for that reason.
Thank you, Francis. I'll go ahead with another question from attendees. Yanni has a question for Karl Whelan. He thanks for the presentations and is asking Karl, is there a deep political ideological constraint to change from current monetary policy into fiscal policy to control inflation? What is the main cause that prevents government to change their approach?
Yeah, great question. And I think what was nice in the session was we started with Francis's title, which was really good, much better than mine. But we ended with my conclusions, which I think are largely that yes, this is a political issue. I would be more encouraged about the possibility of political ideological changes that remove these institutional constraints in some parts of the world than in others. So, for example, when we look at the current U.S. presidential election, we've had a long history, not just in the U.S., of that right-wing parties come in, slash taxes, run big budget deficits, and then leave the left-wing parties or social democratic parties to deal with the deficit, and then discover that debt is a terrible thing when they're in opposition. And then the left-wing parties decide, but we have to show that we're responsible. And so then they worry about debt and deficit more than conservatives ever did. I don't see that so much as a debate in the current presidential election. You see ambitious spending plans, and you don't see Biden talking a lot about how he's going to cut the deficit. I am much more pessimistic about the euro area. I think the euro area is architecture, represents, the best economic thinking as of 1992. And, that's fine, but economic thinking moves on. And the treaties are very hard to change. They have been changed, but it's always been difficult. And I think on these specific issues, attitudes in countries like Germany are such that you will not get treaty change to make monetary financing legal or whatever. That's just not going to happen. In the same way as I sat in last week on the economic policy session with Olivier Blanchard and German Zettelmeier talking about scrapping the fiscal rules. But the fiscal rules are in the treaties. So this is treaty change they're talking about. Really not optimistic that we can get a treaty change that would allow for more expansionary fiscal policy. So politics, yes, and I'd be optimistic in some parts of the world that politics can lead to more expansionary policy, but I am worried about the design of the euro area.
Thank you, Karl. We have a few questions coming, so I'll stay on Karl with another question coming from John Chichester, who's asking this. He basically asking you your view about helicopter money. His question, he says, did you mention the central banks have lapsed into this learned helplessness and have chosen to not use various ways to combat this? One option was to use a helicopter drop of money stimulus, but you mentioned that this would look too much like a stimulus check and would appear as monetary financing. So why would this be bad? if it can help control inflation, is this a path worth exploring?
So I don't think it's bad, but these conventions around monetary financing have grown up and have various levels of strength. You know, the Federal Reserve is constrained in various ways and things that it can do, but those constraints could be changed. And it probably, you know, it would potentially be a good thing. I don't want to focus too much on helicopter money in the sense that that governments are not particularly fiscally constrained right now. Right? We can mail those stimulus checks without having to go and get the central bank to do it. But it, you know, it could be something that you could see introduced in places that will pass the legislation to make it legal. But the euro area has to deal with the legal consequences of Article 123. And the thing to understand about the monetary financing prohibition is that the way it's enforced by the ECJ is they enforce it based on not the letter of the law, because the letter of the law doesn't mention helicopter money or whatever, but they interpret it based on what was intended by the Article 123. And, you know, in recent judgment, they said, well, Article 123 was intended to encourage sound budgetary policy. So cases in which the central bank is printing out money and giving it to the government to pass over to the people, I'm afraid the justices of the ECJ would say, well, that's not sound budgetary policy. So maybe these things can happen elsewhere. There are serious institutional constraints in the euro area.
Thank you. There is another question to Francis Coppola. And this is coming from Miriam Rem, and it goes like this. The distributional effects of monetary loosening appear to me to be not as unanimous as you suggested. There are two channels. One is the asset price effect through asset valuations, which increases wealth inequality, as you mentioned. But also, number two, the real economy effect through higher investment and growth, lower unemployment, rising wages, leading to higher wealth accumulation across the distribution, as well as cheaper mortgage refinancing. The net effect is unclear, and empirical research finds it to be close to a net zero. And this is not just from the mainstream, but also from post-Keynesian researchers in a broader sense. So you view this evidence differently.
I think I did mention in my presentation about trickle-down effects, so I'm not saying they don't exist. I think my point would be much the same as Karl's, really, that you have to do an awful lot of QE for a very small effect. I take issue with you with some of this because there isn't a great deal of evidence that there has been much in the way of higher investment as a consequence of QE, a looser monetary policy, and nor has there been any evidence of rising wages. There has been lower unemployment, but there has been quite sort of heavy amounts of underemployment, and there have also been issues on economic participation rates. So unless you take all of those into account, you don't get a picture of a tightening. When you take all of those into account, you don't get a picture of a tightening labour market as a consequence of looser monetary policy. And much of the research that has been done has ignored effects like that. So I am not convinced that the real economy effect is quite as great as some of this empirical research appears to show. But I'm not saying that it's zero. I just think that there are better ways of doing things. I'm kind of with Karl on this, that, in a way, central banks constrain themselves by refusing to use some of the tools that they have at their disposal, such as helicopter money.
Thank you, Francis. Andrew, would you like to ask your question?
Thank you. Yes, thanks for giving me the floor, Andrea. Very quickly, just to Scott Fullwiler and maybe to Karl. Scott, I understood the first part of your presentation was focusing on the structural determinants of the price level, so arguing that it wasn't really a sort of, balance between aggregate supply and aggregate demand issue, or not as much as people think. But then I sort of thought you said that fiscal policy was better at managing the price level than monetary policy. But whether or not that's not whether it's better managing aggregate demand or not, isn't that a little bit of a contradiction to the first part of your argument, where you seem to be emphasizing structural factors? Question. And just a remark to Karl, I liked all the presentations, but I also liked your presentation, Karl. Just the point about the fiscal capacity of euro area member states. I mean, I would maybe tweak that a bit in the sense that, it's given at the moment, and even a country like Italy can issue debt at very low interest rates. But of course, we know that's, due to the backing of the central bank and other issues. It's not arguably a given for the longer term. And if there was some, political crisis or something, then spreads could rise very quickly. So I'm not sure that the fiscal situation of the euro area countries is quite as secure as you were implying.
Okay, should I start talking now? I was just wondering if Andrea was okay.
Yeah.
Okay. So the point I was making with the price indexes is, first off, there are cyclical components to it. It's somewhere in the neighborhood, at least in the U.S. case, 40 to 50%, it appears from the research, although it doesn't have to be the same case in other countries. And it doesn't have to be the same case across time either. But the point I was making is there's significant effect of the acyclical components of the price index. It doesn't mean you don't have to manage, sorry, I forgot, I don't know if I said that right. There's significant acyclical components to the price index. This doesn't mean, though, that you don't have to manage aggregate demand cyclically. Again, because there is a significant cyclical component of the price index. Also, I would say that I didn't go through it all, but there still is a significant role for the central bank to be playing, because aggregate demand expansion, the last 4 of them in the U.S. have been primarily driven by financial asset prices. And so in that case, the central bank would have been strongly influencing aggregate demand policy, even within an MMT framework.
Scott, maybe Karl, would you like to comment on Andrew's question, which I thought.
Yeah, no, look, Andrew's question is great, and we could have a 90-minute session on exactly how much fiscal space is there in the euro area and what's likely to happen in the future. Of course, euro area countries are, fiscally constrained in a way that other nations are not, because they don't have access to their own money. Okay, we all know that. And in the absence of a central bank willing to sort of backstop the sovereign debt, we know that countries are open to, there's multiple equilibria in terms of the sustainability, debt sustainability, and you could potentially have runs, on the country, and potentially have, buyer's strikes and sovereign defaults at quite low debt to GDP ratios. That's why Mario Draghi's most significant achievement was the OMT announcement. And it's, if you think about it, this was an extraordinary, actually political intervention, in the sense that, the ECB, Draghi's ECB decided that they could disagree with financial markets about whether or not a country was solvent, and they could make the judgment that they're going to intervene and keep the flow of money going, and there's various conditions placed on it and so on. It's been great so far, in that OMT hasn't had to be operationalized at all, and yet people still think that the ECB is there to be the sort of market maker of last resort. I would just offer a concern about this, and then this would agree with Andrew. which is that the ECB is now accumulating via its asset purchase programs very large quantities of sovereign bonds. So they've already started to waive limits that they had, self-imposed limits, saying they were only going to buy a third of the debt. But of course, the asset purchase programs, were litigated. Everything the ECB does gets litigated. So they were litigated with the ECJ. ECJ's judgment on asset purchase programs and that they were not, and the decision to say they were not monetary financing, partially rested on approval of these limits and saying, look, the ECB has these limits, and so that means it's not monetary financing. I am concerned that we will reach a point where the euro system has such large holdings of sovereign debt that it doesn't anymore have the room to do the large and ongoing purchases that would be necessary to implement an OMT strategy. And if financial markets call the ECB's bluff, ECJ doesn't let them purchase additional sovereign bonds, then it could be game over. So I agree, euro area countries are just not in as comfortable a position. But right now, most of them can issue at negative rates, and they should do so, and they should stop worrying about the debt.
Thank you, Karl. We are ending our session, and I'm afraid, I'll have to cut off some of the remaining questions. But there is one question that I take the liberty. It's not directed to any speaker, but I take the liberty to direct to Scott, asking Scott to give us a 30-second answer. And this is a question about the inflation experienced in the prices in the Corona crisis. Clemens Lukic is asking that prices in the Corona crisis have been rising significantly more than the statistics show. And what is there to say about the calculation of the official inflation rate? Scott, can you give us a quick answer to this, given that you discussed the measurement of price index?
Well, largely I can only refer to what I've looked into, of course, but there are definitely pockets of price increases in certain places. The one that I showed where the San Francisco Fed economist was looking at it, of course, that was the data gathered for the different components and so forth. So he was using the official data. So I guess the short answer would be if that's what's happening, it's a good indication of how price indexes need to continuously be evaluated in terms of if they're getting a complete picture. So I don't have a good answer on if that assertion was correct, but beyond that, that's what I would say.
Okay, I don't know if we have the time for a very quick concluding remarks by speakers. We should do it in very short comments, and maybe reversed order. Karl, any last final comment? I'm asking you to be very short because we're 6:30 now.
I would just say that we need people in Germany to entertain the ideas of more radical changes to the euro area framework. So your institute and people like you are to be commended.
Thank you, Scott.
I think I'm just going to second Karl's point in the interest of time there.
And Francis,
I think I'd put out an appeal to end the kind of sort of perceived separation and even antagonism between central banks and fiscal authorities, and for them all to learn to cooperate very much better than they have done for the last few decades.
Thank you. I really want to thank all speakers, all attendees, everyone who watched us on the internet, on the stream, on streaming. We're not at the Steglitz Hotel, so we cannot offer a snack or a coffee, so you will have to take care of that. But at 7 p.m., after a little break, we have a third session on the Fed and the ECB in uncharted waters. So the discussion of monetary policy will continue in about half an hour for the FMM conference. Thank you all. Thank you very much.